Recently, I got an email from a reader asking about when to sell his stock. And in the email, it reads, Dear Willie, you see, I have a significant holding in this company called Singapore Shipping Corporation, or SSC. After reading this article of yours, I am in a quandary. SSC has been giving consistent dividends from day one. Since its listing on 24th November 2000, the company has never reported a loss nor omitted a dividend payment. However, in the 2026 annual report, I felt queasy after reading the chairman's message. And my reader goes on to explain its current financial situation of the company. And he was concerned, right? He said, Do you think there's a way out for the company? And should I sell? Now, there are many times when it comes as an investor, the most tricky thing about investing is knowing when to sell. Of course, we know what stocks to buy, when to actually buy, how much to actually put all these stocks in a diversified portfolio. The challenge comes on knowing when is the right time to sell. And in today's video, I want to go through with you what are the three golden rules I use personally as an investor, knowing how to sell and when to sell your stock. So I have also wrote this in my blog as well, and I would like to show it to you right here. So when to sell a stock, I developed three simple investing rules on when to sell a stock. And this is based on the principles by a very famous fund manager and investor called Philip Fisher. I highly recommend you to read his book called Common Stocks and Uncommon Profit. It has a chapter on when to sell a stock. Now, I've summarized it in my blog here, and there are basically three golden rules of when to sell a stock. Now, the first rule when it comes to selling a stock is when a stock no longer meets my investment checklist. This means the company has started reporting falling revenues, its profits continue to decline year after year, and what's more crucial is its competitive mode or competitive advantage has been disrupted. So you can tell when the company's profit margin starts to drop, it starts to lower prices, and it even needs to start raising money, right? Borrow debt, borrow money from the bank, from loans in order to continue its operations. Now, when that happens and it fails my investment checklist, straight away I will sell, whether I will take profits or I'll cut loss. Now, the second rule when it comes to selling my stock is when I made a mistake, which means that there could be a misjudgment on the stock itself. So this happens when facts of a company are actually less favorable than I first thought. Now, many years ago, I invested in this handbag company based in the US. And the problem was that the management was selling a very, very bright future or a very sexy story. So when the stock kept falling, the company said that it was going to restructure, it was going to recover, but it never did. So I got carried away by the management's smooth talk. Now, in this case, I would sell the stock, right? Because when the facts change, when the story changes, then that also changes my mind as an investor. Now, the last golden rule is what I call when I find or when I found better opportunities. Why? Because different risk reward conditions will have serious implications on how we put our capital. For example, when I invest in a stock and I know that this stock has hit or is very close to my intrinsic valuation compared to another stock or another opportunity which I have found, and the other opportunity is such that the company or the stock has yet to reach its intrinsic value. That means I want to buy this stock at a big discount. So this means that there are different risk to reward. I would rather take profit on the company where it's reaching close to its intrinsic value and switch it out and invest into another company or another stock where it has yet to realize its full potential or its full intrinsic value. So this is when I found a better opportunity. Sometimes there might be cases I would also sell if the valuation gets too expensive, or that means the stock is overvalued. So what this means is that the stock is trading way above its intrinsic value. Now, if that's the case, then I would also switch it out. So these are the three golden rules of when I want to sell my stock. when a stock no longer meets my investment checklist, when I made a mistake, or when I found better opportunities. Sometimes I will also sell if the valuation gets too expensive. Moving back to the question by my reader. So if you see, my reader, he mentioned he felt queasy after reading the chairman's statement. And what the chairman said was he candidly highlighted the rapidly aging profile of SSC's fleet of 5 ships, 4 of which are approaching the end of their economic useful lives, necessitating a substantial and sustained program of renewal. The challenge is the materially higher cost of new builds. The cost of a new generation car carrier vessel could be around 120 to 150 million US dollars. Now, the company's current net cash of $46 million is not sufficient to fund fleet replacements at prevailing capital expenditure levels. To take on huge debt to replace the fleet is untenable and unthinkable. Now, I think it's good to understand how we can apply the framework to his question. So coming back to the current situation, what I will do is, first of all, I want to figure out whether the company's financial situation is still in a very operationally healthy position. So what I do is I will look at the company's financial report, and this is how I'm going to share it with you. If you look here, this is the company's annual report, the latest annual report, which is ended 31st March 2026. And you can see in its latest balance sheet, the company has roughly about $97 million in cash. The company management said that it has right now about 46 million, so that has actually dropped. We also need to understand that the company still have roughly about $5.3 million of borrowings, which it needs to pay over the next 12 months, right? You can see from the current liabilities. So what we need to understand is whether the company has the ability to raise money to replace some of its older vessels. So what we need to look at is the amount of free cash flow that is coming into the company. So if we look down to the cash flow statement, in its latest 2026 results, SSC has generated roughly about $23 million of operating profits, of operating cash profits. And it pays out roughly about $1.2 million of capital spending. This means that it has a free cash flow of roughly about $22 million. Free cash flow is the ability of a company to collect more of its cash profits than pay out to invest into the business. And if you see for SSC's free cash flow numbers, over the last couple of years, it has generated an average free cash flow of roughly about $20 to $23 million per year. So if you come back to the current situation here, one thing which I would ask myself is whether the replacement value of the ships, whether it needs to replace, how much does it need to exactly replace these vessels? So I can simply ask, either the chairman, or I can either go around asking for friends who are in the industry, and I want to calculate exactly how much is it that it needs to actually replace. It might replace a few of these ships, it might replace all 4 of them, or it might be able to extend the life of some of these vessels. So what I need to understand is whether it has enough cash coming into the business over the next 1-2 years in order to replace its fleet. And if it's not able to do so, then how much money it needs to borrow. And when it has to borrow a certain amount of money, is it taking too much leverage or too much debt? So these are the questions which I want to ask myself, because when a company takes on too much debt, then it could weaken the fundamentals of the business. Now, my reader also goes on to ask, the ship owning and chartering business is asset heavy. Wonder if there's a way for the company to pivot to an asset-light business. Now, one thing which I want to share with you is for companies which tend to pivot into a different business model. For example, like the hyperscalers today, where they are going from asset-light to more asset-heavy businesses, they're able to do so because they're able to generate free cash flow, and they're able to take on this excess profits to reinvest into a different business model. Now, for most companies, when they start to pivot to a different strategies if they're already struggling or if they're facing challenges, and because of that they try to pivot. That usually could be a signal for tough times ahead. Now, another thing which I like to point out in this email as well is my reader also mentioned that it's not easy to do this consistently when it comes to selling, as daily trading volumes are small unless I sell at a significant discount. So another thing which we need to understand when we decide to whether to sell a stock or not is to see whether there's enough trading volume. Because even if we don't sell a stock today, if we try to sell the same kind of stock 6 months from now, 12 months from now, there will always be what I call a trading volume issue or a liquidity issue, which means that it's not that easy to sell a stock. Now, when it comes to this kind of situation, in the first place, I would try not to invest in such businesses because it might be difficult. When I need the money or I need the cash from this stock, I might not be able to sell it readily. So, when to sell a stock, I do have a simple framework to follow. If you look at my framework, very simply, the first thing which I want to do is to be looking at, number one, I want to see whether a stock still meets my investing checklist. If it doesn't meet my investing checklist, which means that the company keeps reporting falling revenues, dropping profits, and the competitive modes gets disrupted, and it has to actually start raising a lot more money, borrow more money, then this is a red flag. Now, the second reason I would sell my stock is when I made a mistake. When the story or when the facts of the company changes, I would also change my mind. I would also sell my stock. Third, when I found better opportunities, which means that if I find another stock which it has yet to hit its intrinsic valuation or its intrinsic value potential, then I would actually switch out from a stock which has already hit its intrinsic value and there's not much upside left, and I'll switch it out. Now, there's also one more thing is I will sell a stock when valuation gets too expensive or it's overvalued. This means that the stock price is currently trading way more than its intrinsic value. So these are my 3 golden rules. And if you like what you see, do share, like, and comment, and I'll see you in the next video.